Hi guys, this is Mark Shawson, the Pattern Trader. Welcome to the two-day boot camp. We'll be starting in just a moment, but in the meantime, would you put your name and where you're from in the chat box? So we have Merle, Marion, how are you? Merle, can you see my screen now? We have Johnny from New York, Vishwas from Toronto. Good to see you again, Vishwas. We have Masni from the UK. Louis from Minnesota. So please go ahead and put your name and where you're from in the question in the chat box there. We're also live streaming on YouTube. See you again, Vishwas. So for you guys on YouTube, we're going to be 30-second delay. So there's a 30-second delay between the time I say or share something to when you see it. We have Dave from the UK, Phil from Scotland. So welcome everybody. If you haven't already done so, please put your name and where you're from in the question box, or in the chat box rather, sorry. So I'll give this another minute or so. We have Serge from Toronto. We have Peter from Boston. So if you're ready, haven't already done so, please put your name and where you're from in the chat box. All right, I'll just give this one more like 30 seconds and then we can get cracking. If you haven't already done so, please put your name and where you're from in the chat box. All right, guys, welcome to the two-day boot camp. My name again is Mark Shawson, the Pattern Trader. I've entitled this little get-together, How to Capitalize on Big Moves and Market Reversals in All Trading Markets. So hopefully by the end of the next 2 days, you'll come to appreciate that my very simple but powerful price action, price pattern trading methodology can be applied in any trading market. So it doesn't matter if you're trading the stock market, oil, gold, FX, or the commodity futures markets. You can use all of the tools that we'll be talking about. So in today's presentation, I'm going to give you a little bit of a background of my own journey, my own trading career, and then I'm going to give you a very detailed explanation of my price pattern methodology that has enabled me to capitalize about 500 pips on average per month since I started the Pattern Trader in September 2015. This doesn't mean that I win every month, but on balance, on average, I'm winning about 500 pips. I also actively trade the stock market and oil and gold, and I'll share all of that with you today. And then also after today's presentation, I'll go into the live markets. I'll take a look at the live markets from a global point of view, give you an understanding of how the patterns dominate and give you an understanding of where the major direction is going to come from, and then how to hitch a ride on those major moves. In tomorrow's presentation, I'll do a bit of a review, and then I'll also talk about risk management. Risk management's a very overlooked component of trading, and in tomorrow's presentation, I'll give you a very important tool to make sure that you understand how to size your trades correctly. And then tomorrow we'll set up a trade under live market conditions. So this isn't some theoretical education thing where you kind of learn some nifty tricks and you don't know whether it works or it doesn't work. So first off, I'm a trader first. I've been trading the markets actively for over 3 decades. I kind of started the pattern trader just as an idea, a way to give back what I've learned. I thoroughly enjoy it. I get a lot of gratification from it, but believe me, my first job is actively trading the markets, and I take active positions in the markets. So, let me give you kind of a understanding. I don't look for 7 pip moves or 15 pip moves on some magic moving average crossover. I look at the bigger moves in the market. This is a representative month where I made 18 trades. So instead of making 5 or 10 trades a day, I made 18 trades in a month. So I'm just looking for the highest, risk to reward trades, the highest probability trades that are going to be in my favor. And so out of these 18 trades, only about 3 of them won very big. You can see I made over 800 pips on this one, almost 800 on that one, and 474. So those 3 trades were primarily responsible for making me over 1,700 pips in 1 month. Now, I did this despite losing 60% of my trades. So this to me is really the holy grail of trading, is being able to lose most of your trades and yet still come out with a big winner. So this is what I'm going to talk about today, how I look at, major trends or chart patterns that indicate reversals that we can hop on for 200 pip, 400 pip, 800 pip winners. So I'm not looking to duke it out with my broker and, take 5 pips here and 7 pips there while I'm paying a 3 pip spread. And that's going to be a very important distinction. So Louis says, how much time can we plan for today's presentation? About an hour and a half, I'd say, Louis. There will be a Q&A after the presentation, so it's really up to you. So with that said, I'm going to tee up the presentation. After this, I'll come back and take all of your questions, and then we'll go into the live markets.
So today I'm going to teach you how I lose most of my trades, yet still come out with an average of 400 to 500 pips profit per month, and how I do this consistently. So imagine not caring when you lose a trade. Imagine losing 5 or even 10 trades in a row, and yet you're still making good cash in the markets. That to me is the true holy grail of trading. Being wrong most of the time, yet still pulling in good money in the markets. And I'll show you just what I mean in a moment. In today's agenda, I'm going to briefly reveal a little bit about how I got started in my trading journey and how this propelled me to a successful 23-year career on Wall Street. I'm also going to share with you my simple price action, price pattern, trading strategy, and methodology that consistently pulls in huge gains over the long run. I'm going to share with you real trade examples like a recent pound yen trade that I pulled in over 650 pips in just a few days. Also, how to spot a market coil that would have yielded you a quick 154 pip winner in the dollar versus yen, and many more real-time trade examples, and how many traders are using the information that you're seeing today to make big monetary gains in the market. But before I continue, I want to make sure that we are all on the same page and have you agree that hanging around in internet forums seeking advice from internet newbies is just not how you're going to make money over the long term. Also, I would forget about EAs, also known as expert advisors. These are, mechanical trading robots that you can find on the internet for $150 or $350 or what have you. It's kind of counterintuitive to think that you could just go on, buy something like that, and it will make money week in and week out. I assure you, if there was something out there, the institutions like JP Morgan and Goldman Sachs would be paying billions of dollars for it, and they simply just don't work. You have to want a system that works forever, not 6 months, not 12 months, but forever. So put a yes in the chat box if you agree to this kind of advice. Unfortunately, most people don't make money in the Forex market, and here are a couple reasons why. I suspect that most people are in it and looking for just the quick, easy money, or they're just looking for the rush, the bump, or the action. Or using trading strategies that don't work over the long term, and simply they aren't interested or capable of what it really takes to be a successful trader, which is a good deal of discipline and patience. So just because I'm making a lot of money in the market doesn't automatically mean that you will. So you have to make a decision right now, whether you're in it just for the action or you're in it to make a long-term sustainable income. Having said that, there are a lot of people following my signals right now who are making a lot of money with my trading strategy, and it's because they are committed and hungry for success. So I'm going to just go into a brief introduction of myself. I'm the chap on the left. The handsome guy on my right is my son, Elon. Ever since I had my son, it just gave me enormous focus and commitment. And I wake up every day knowing what my purpose is in life. I'm also known as one of the most successful market reversal pattern traders, with over 1,000 traders following my analysis online today. However, it wasn't always like this. So I began my trading career or journey back in 1978, 1979 timeframe. I was in my last year of business school at USC Business School out in Los Angeles. And at that time, my dad was looking for funds for a drive-through safari park by the name of Lion Country Safari. And he came across an investment banker by the name of Grant Loving, who actually helped him raise the money for his venture. In addition to being a successful investment banker, Graham was also a very successful commodities trader. So I don't know how many of you remember back to the 1970s timeframe, but we had Jimmy Carter as the president of the United States. We had several oil embargoes out of the Middle East that resulted in long gas lines. This was the first time that gold ran to $1,000. The Hunt brothers had cornered the silver market, and silver ran to $50. Interest rates were on their way to 21% because of rampant inflation at that time, and the markets were going nuts. And so Graham was trading all these exotic commodities markets, from oil, cocoa, soybeans, pork bellies, gold, what have you, about 15 different very exotic trading markets. And he was doing this very successfully. So when he invited my dad to join with him in a trading account, my dad, of course, leapt at the chance. And my dad ponied up 50,000. Graham put in 450,000. And so starting with a $500,000 account in late 1978, 12 months later, Graham turned that 500,000 into $5 million. Now, it wasn't just how much money Graham was making and how successful he was, but what intrigued me was how he was doing it. So remember, I was taking these fancy investment courses at USC Business School, and I was being taught to evaluate investments from what we call a fundamental approach, dissecting every piece of information from PE ratios to sales turnover to balance sheets and everything you would to make an investment decision from a fundamental standpoint. But Graham was making decisions simply from a price or price action standpoint. And every day he would simply mark the price down on a simple piece of graph paper. Remember, this was before the internet, before these fancy charting services. Graham would go down to the corner stationery store, buy some graph paper, and just plot an x-axis and a y-axis. And every day he would just plot the closing prices of live cattle or soybeans or whatever he's following. And over the course of 2 or 3 weeks, that line would either be going up or it would be going down. And he'd say, Mark, I simply want to buy a market that's going up or sell a market that's going down, sixth grade kind of stuff. But Graham was applying this and being very successful at it. And of course, I had a front row seat to all of this. Graham would come over very often for dinner or stay overnight, turn on the local financial TV station in the morning and watch these commodity clacker boards. In those days, the commodity boards were literally made out of metal. So every time the price turned over, you could hear them literally clacking. And, I was watching Graham making hundreds of thousands and millions of dollars in a very short time frame. So, of course, at that time, seeking what I was going to do for my life's passion and career, I very quickly became, attuned to trading and wanted to learn as much as I could in the markets to be successful for myself and others. So with that, I started on a Wall Street career. I initially joined Merrill Lynch in 1980 as a stockbroker, and then went on to work for 8 major Wall Street firms over the course of a decade and a half from that time. I ran a commodity division for E.F. Hutton in Beverly Hills. I was also with Mike Milken's Drexel Burnham in the late 80s. And then in the early 90s, I was with a small $175 billion hedge fund called Bridgewater Associates in New York. And all this time, I was trading my own account. I was trading the account of high net worth investors and small institutions, making a ton of money and having a lot of fun. And then early 90s, I made a very large mistake. I was on a phone call with my brother. My brother was very enthusiastic about a stock he wanted to buy based on what he represented over the phone. I bought a small amount of stock. I'm not going to go into the gory details, but I soon came to learn that my brother learned of this trade through insider trading information. And I was embroiled in a 10-year investigation by the SEC. And after 10 years, I wasn't fined any money. I wasn't criminally indicted, but I had to sign a document that effectively was a stain on my reputation at the time. And so for that time, my Wall Street career came to an end. But as I tell my son, when one door closes, another one opens. And so in early 2000, my son was born, and I just really wanted to stay home and spend every minute I could with him. So basically, I decided to apply everything I'd learned on Wall Street, all the trading principles I'd learned from Graham Loving, and all my experience from that time. And I started trading a small five-figure account from home in the early 2000s. And by 2010, that account had grown to well over seven figures. In 2010, I met my partner at the Pattern Trader, Peter Visser, online. We kind of came to meet each other online. We had a common passion for trading. We had a common background. We were both from South Africa, and we started talking to each other and sharing ideas. Peter had just started a signal business in which he had a few accounts, and he was initially successful and then came to learn how difficult it is trading in the markets. And after he found, my methodology, and he saw my methodology, he basically just turned over his entire business to me and started turning his attention to marketing. And a couple years later, he begged me to share what I did with the public at large. And I initially resisted him for many years because trading ultimately is a loner business. You have to be able to walk into the pits, and when everyone's yelling out buy, you have to have the confidence to yell out sell, and you have to have the courage of your conviction. So I really didn't want the pressure of having all these traders, whether they were winning or losing, and the burden of that. But some years later, beyond that, Peter begged me. He said, "Look, I'll do your website, I'll do all your marketing, I'll leave you to do exactly what you want to do, which is trade." And on that premise, I started the Pattern Trader in September of 2015. And it's been an inordinately successful venture, not only for me, but for the many people that started following from me from that time. I estimate that from September 2015 to the end of 2016, I generated well over 4,000 pips for people who followed each one of my trades since that time. And we have review websites where you can go and learn what other people's experience was. So let me move on and discuss the big question as to why most traders lose. And lose they do. This isn't my opinion. The statistics in this business are abhorrent. It's estimated that well north of 90% of people will lose most or all of their money within the first 3 months of opening their account. And I think a lot of the reasons, when I first became interested in doing this, I kind of signed up to a lot of websites and mentors and people who claimed to know what they were doing. And I started noticing that most of the things that they're representing or teaching are just dead wrong. And the biggest myth or lie, I don't really like to use the word lie, is that internet marketers will have you believe that their past results mean that you can make money using their systems. And I promise you that the real pros on Wall Street don't rely on third-party results from marketers they don't know. So the question you need to ask after me presenting my methodology today is it understandable? Is it logical? Does it appear to have longevity? Does it appear to have a unique edge? And ultimately, can you replicate the trade? So I would say never make a purchasing decision in this business based on past performance. It's truly no indication of future results. The other big myth is that you need to win most of your trades in order to become a long-term, consistent trader. And I think this myth persists because I think most of the systems out there are so short-term in nature. Most people are, trading off 5-minute or 10-minute or 15-minute charts. They're trying to extract 5 or 10 or 20 or 30 pips out of an individual trade many times a day. And if you're doing this, then you do indeed need to win most of your trades, because it just stands to reason that if you're looking to make 20 pips, you have to risk 10 to 20 pips to make that amount. You also have to overcome the broker spread, and that you do have to be consistently winning in order to have a positive outcome with that kind of strategy. But as you'll come to find out, that I look for trades that have a minimum risk reward ratio of at least 3 to 1. That means if I'm looking to risk 50 pips, I need to see a trade that has at least 150 pip risk reward outcome. And I will maintain that most trading strategies out there are simply not designed with an adequate risk reward ratio. That means, that you have to win 80 or 90% of the time if you just have a 1 to 1. But the math will tell you that you can lose 72% of your trades if you have a 3 to 1 risk reward ratio on your trades. And now this is a pretty complicated concept, but I'll keep on revisiting it to reinforce this risk reward concept. So this is a snapshot trading activity. So in this particular month, I did 15 trades, but lost 8 out of the 15 trades, which meant that I lost over 50% of my trades for that month, and yet still came out with a positive total of over 1,100 pips for 1 month. So that isn't a typo. Most people would love to make 1,100 pips in a year or even a lifetime, and this is what I made in 1 month. And it's because I am targeting trades that move at least 200, 500, 800, or even 1,000 pips on an individual move. I'm not looking for small 10, 20 pip moves out of a 10-minute chart. And as you can see, by doing this, I only need to be successful 2 or 3 times a month. I only need to find 2 or 3 big trades a month, and that manages to overcome all the losers and overcome the broker spread and put me in the winning column over the course of time. And I will maintain that unless you have a strategy that targets these bigger moves, that is going to be very difficult to maintain a profitable record over time. So you can see that in the end part of November, I had a host of losing trades, but these were all compensated with just a couple of trades in the beginning of the month where I made 258 pips on this euro pound trade. I actually sat in this pound yen trade for 13 days and made over 600 pips on that trade. I made 300 pips in a gold trade in that period of time. So just with a couple of trades, I was able to overcome a succession of losers, as well as the broker spread and all the volatility that's associated in this business, and come out with a positive return. And this is my strategy each month. So again, the emphasis is in the quality of the trades and not the quantity of trades. Some people are trading 20 times a day. I'm looking to make 20 trades a month. Now, as I indicated, I get a lot of emails and I sit on a lot of webinars to see what my competitors are saying and doing. And I kid you not, this was a screenshot from a webinar I sat on just a couple months ago. And, I can only imagine this is some kind of short-term trading instrument overlaid with what we call a number of lagging indicators, whether it be Bollinger Bands or MACD or stochastics or moving averages. These are called lagging indicators. And I don't know about you, after about 10 minutes, I had to hop off this webinar because irrespective of whether it made money or not, my eyes started to cross. And unfortunately, I suspect that maybe a lot of your trading screens are looking like this, where it's just cluttered with a lot of lagging indicators. This is what I focus on. This is known as a clean chart or also a naked chart. And the reason why it's called a naked chart is because you'll notice there are no lagging indicators overlaid on top of this chart. There's no MACD, there's no stochastics, there's no moving average, there's no Fibonacci's. There's just bars with a low, high, and close. Sorry, excuse me. So it's not even a candlestick chart. It's just low, high, and close. And as you'll come to learn, I focus on how a market closes relative to the high and low of that particular bar. So again, what I'm looking to do is target moves where this chart went from 92 all the way to 79. This was a $13,000 move for every $1,000 you put up. And my objective is to take 4, 5, 700 pips out of the middle of a trend like this. Similarly, when it shot up from 79 all the way to 87, that was an $8,000 move for every $1,000 you put up. And again, my objective is to take 3 or 4 or 500 pips out of a move like that. So this may be a little bit redundant for some, but let me share with you exactly what I mean by a bar and what that means. So every trading day, we know that the FX markets trade continuously from Sunday through Friday, but each 24-hour session is denoted by a low to the session, a high to the session, and this slash mark indicates where that session closed. So typically the close is 5 p.m. Eastern, and then some charts it's also represented by at 8 p.m. Eastern. But there is always a session low, high, and close. And I look at the close relative to the high and low. And as you'll notice, this particular close was much closer to the high than the low, which indicates that the buyers won the day on that particular day. Now, I don't just look at a bar in a vacuum. I look at in context of an overall trend or pattern, and I'll explain that in just a moment. This is an indication of a bar where the market went higher, went lower, and then settled much closer to the low than it did the high, again indicating that the sellers won the day within the context of a trend or chart pattern. So now this is my trading strategy. So at any given time, I have 30 trading instruments on my broker platform. I look at most of the FX markets, the Forex markets, as well as other cash instruments, including gold, oil, and some of the global indexes. But as I indicated, you can trade stocks, so whether you're trading Netflix or Amazon or Apple or whatever stock you might be looking at, or if you're looking at commodity futures, whether it be corn or pork bellies or cocoa, you can apply the same principles of this price action, price pattern trading strategy. So as I indicated, I have about 30 different trading instruments. And at the end of the day, I'm just trying to evaluate the best and the most high probability trade setups for the next trading session. And usually it just comes down to one or two, and then many times I have no trades at all if I don't see an opportunity. And that's where the discipline and the patience come in, but I'll get into that in a moment. So if I open any of my given instruments, whether it be Euro versus USD or pound versus yen, the first thing I'm trying to assess is what is the phase or the condition of that market. And by and large, you've been told that there are only three ways a market can be going at any one time. The market can be going up, going down, or thrashing around between a resistance and support zone in a sideways market. But I'm going to add a couple of other nuances. To my mind, the market can also be turning from down to up, or in this case, from up to down. And this is where I consider I have a very large edge, because before these markets turn, they always put on a price pattern that is pretty recognizable. And so even though market participants might, be caught unaware or surprised when a market makes a 180-degree turn like this, the market does put on a look before it does that. And this is where I can, very easily get in, early and capitalize on it big time. So again, these are the phases or the conditions of the market at any one time. So whatever instrument we open up, we just want to make an initial determination of whether this market is trending up, trending down, crashing around sideways, or turning, in this case from bearish to bullish or from bullish to bearish. Now, if the market is turning, as I indicated, there will always be what I call a historical precedent or chart pattern that precedes that turn. Now, you can consult any number of technical analysis websites or textbooks, and it'll show you many, many patterns. Today, I'm just going to share with you a handful of these chart patterns, and then we're going to look at the live markets and see how there are a number of markets that have turned with these patterns in the rear view mirror. So the first major chart pattern that I want to share with you is what I call the double top or double bottom. And it's just the way it sounds. So this is an indication of prices that were heading up, hit a resistance point, backed off, hit that peak again, and then backed off. And then when it crosses what we call this neckline, which is simply a line drawn through the pattern, it reveals what we call an M top or a double top. And this is indicative of a market that is reversing from a market that was going up, hit this double top, and then indicated a market that was going down. If we look at the euro versus British pound right now, we can see that it made a double top in the late November 2016 timeframe, and I was able to successfully short that in the recognition of this price pattern. On the other hand, this is a market that was headed down, made one trough, backed off, retested that area again, and then successfully went the other way. And when we look back, it looks like a W or a double bottom. And the Australian dollar and the New Zealand dollar versus US dollar all have the same kind of looking W bottom patterns on the weekly charts right now, which may be indicating a higher move in the future course and trajectory of those pairs. This is a head and shoulders chart pattern, and it's just the way it sounds. So this looks just like a man or woman's head, left shoulder, right shoulder. And when we cross a line through the entire pattern, it's called a neckline. And I'm going to show you the weekly dollar yen that I recognized this head and shoulders pattern at 124 and was able to short that market all the way to 100 in the dollar yen recently. This is an indication of just the opposite. It's called an inverted head and shoulders, and it's just an upside down version of this head and shoulders, which indicates a market that is reversing from a market that was going down. When it completes this inverted head and shoulders formation, it then indicates a market that is going to shoot out the other way. This is a number of different triangles. The first one is called an ascending wedge triangle. It's denoted by a sloping uptrend line against a horizontal line that connects the highs. And when we look at the dollar Swiss franc or the dollar Canadian, we see that this kind of ascending wedge triangle is being traced out while we speak. On the other hand, this is what we refer to as a descending wedge triangle. And I'm going to show you chart after chart that is traced out exactly a bear looking triangle pattern like this. This is typically indicative of a market that was going up, and then when this pattern or this triangle is completed, it indicates a market that will inevitably crater or go much lower once it completes this triangle. And again, I'm going to show you today a number of descending wedge triangles. This is just a fancy version of the double bottom. It's called a cup and handle, where we see the cup and the handle. These are a number of different channels. If we see this at the top or bottom of a market, it's either a rectangle bottom or a rectangle top. We see that the euro pound broke out of this many months ago. The dollar yen broke out of this on a daily basis not too long ago. And these are just a variety of different channels that we see in the market all the time. So again, this is a layered approach. One step confirms the other. And so just because we either identify a trend or a chart pattern, we don't just simply wade in at the market. We wait for what I call an insurance day bar. And this is kind of my own little personal slogan for this particular bar. And the reason why I've called it an insurance day bar is because when we see this particular bar, it actually isolates exactly when the momentum is likely to continue in our favor, and also tells us where and how to place our risk. So what exactly is my definition of an insurance day bar? Well, the first definition is what I call a key reversal. And a key reversal is exactly what it sounds. So this is representative of a market that was stair-stepping lower, the point where there are no more sellers, and then reverses 100 miles an hour and closes in the opposite direction. And when we see these reversals, very often, this is where the market is pointing to where it wants to go. So we don't have to be geniuses with an MIT degree in economics to know when these market reversals are happening. The market actually tells you the direction where it wants to go and when it wants to go when we see these. This is another example of a market that was going higher, hits a point where there are no more buyers, reverses and closes on the opposite end of that daily bar. And of course, the larger the bar, the more robust an indication of that signal to come. And again, this may be, depending on where this reversal occurs, maybe a signal that the market is pointing exactly where it wants to go by closing in this kind of reversal fashion. So again, when we see these key reversal bars in context of a trend or in context of a chart pattern, then we have the beginnings of a high probability setup. Now, my second definition of an insurance day bar is what we call an inside day bar or narrow range day bar. And it's just what it sounds like. So this is an example where the high and low of this particular bar, this daily bar, each bar represents one day, sits within the high and low of the previous day. And you'll also notice that the range from low to high is much smaller or narrower than the preceding ranges of the preceding trading sessions. So this to me represents a coil or a storing of energy. And the metaphor I always use or comparison is a beach ball effect, where picture, if you will, you suppress a beach ball underwater, you keep pushing it, pushing it, pushing it, and then you take your hand away. What happens? It just explodes to the other way. And this is exactly what happens when we see the presence of these narrow range or inside day bars in the market. Now, I recognize you're just looking at a cartoon on a page right now, but I'm going to show you on the live market conditions how the markets explode out of these coils all the time. This is an example of a key reversal and an inside day bar where we have this coiling effect, this beach ball effect. And then when we have a release of this energy, we can expect this kind of movement in the markets. So as I said, this is a layered approach, and each step confirms the other. So even though we might have confirmed a trend or a chart pattern indicating a turn in the market, then we see the presence of our inside day bar or key reversal bar, insurance day bar. Then we wait and layer it all with an execution plan in the form of a pending or resting order. So effectively, the pending or resting order requires the market to ultimately confirm our entry point. So up to this step 4, all our analysis, whether it's our analysis of whether we're in a trend, whether we're in a reversal chart pattern, whether we have our key reversal bar, whether we have an inside day bar, this is all our own subjective analysis. And we can be right and we can be wrong, but the market is never wrong. The market is always 100% right. So by using this execution plan, we require the market to confirm our entry point. And then also this resting order also puts us in at exactly the time that the market is ready to go in our favor. And let me show you exactly what I mean. So this would be an example of, let's say we've identified our insurance day bar in the form of a key reversal, where the market opened lower, as indicated by this slash mark, and then went higher and then closed on the high of the day, within, again, the context of a trend that's going higher or a chart pattern that indicates this market is going higher. And now we're interested in taking a position on the long side. Again, I don't just arbitrarily get in when the market closes for the past session. I put in a buy stop, resting order, or pending order just above the previous session high, usually by about 1 or 2 pips. So I'm not going to go into a huge explanation of buy stops or sell stops. You can go to your execution orders in your MetaTrader platform, and you can see a buy stop and sell stop there. But effectively, we place a buy stop above where the market is currently trading. In this case, I typically place a buy stop 1 or 2 pips above the high of the previous day's range. And then I put my sell stop just the other side of the close or the unchanged of the previous day's bar. So two scenarios can happen once we place our buy stop. The first is the market opens for the next session, drifts lower, and then never recovers. It just keeps on going down, and our buy stop is never triggered. Then I simply just cancel the buy stop 24 hours after I place it, or roughly just before the start of the next session. The other scenario is the market opens, goes lower, and 1 hour later or 2 in the morning while we're sleeping, our buy stop is triggered. And now we're placed in the market at the time and place where hopefully the market is ready to go in our favor. And now we just want to see, obviously, the market to keep going in the direction that we've analyzed it to go. What we don't want to happen is the market goes higher through our buy stop and then starts drifting lower. And then at some point, if it drifts too low, we're going to want to protect our account. And that's why our stop loss is just placed on the other side of unchanged. So again, the stop loss is a bit of an art. It's not a science. What we want to do is not place our stop loss too close to where we might get prematurely stopped out only to watch the market go in the direction we were hoping, but not too far where we're exposing ourselves to too much risk. And this is what it would look like under live market conditions where hypothetically we've isolated our key reversal, which is now pointing in the direction higher. It's now been complemented with this inside day or narrow range day bar. Now we look to probe the market in the form of putting a buy stop 1 or 2 pips above this inside day bar high, putting our stop loss on the other side of the unchanged, and then hopefully looking for the ensuing market action that looks like this. Now, I recognize a lot of you are going to have questions about take profit and things of that nature, and we will get all of that today or in tomorrow's session. This is an example of an order where we may want to probe the market on the downside, where we have a daily bar where we open higher, plunge lower, and then closed on the low part of the bar, indicating an opportunity we may want to get in on the short side. But instead of just arbitrarily going short at the next session open, we place our sell stop 1 or 2 pips below the low of that session bar. Again, we're looking for the market to confirm our entry order. And if the market keeps going higher, our entry order is never triggered. No harm, no foul. We just cancel it the next day. Similarly, we put our stop loss just the other side of the previous day's close or unchanged level to protect our account. And this is what it could look like under live market conditions. And again, I recognize this is a cartoon on a page, but I'm going to show you time and again where I implemented this kind of discipline and made hundreds and hundreds of pips by articulating market setups just like this. So just as a quick review, again, this is a target methodology that takes you closer and closer to the bullseye of a high probability trade setup. So again, irrespective of the instrument you're looking to trade, whether it be a stock or a commodity or an FX pair, you first want to identify what is the main phase or condition of that market. Is that market trending up? Is it trending lower? Is it thrashing around sideways? Or does it appear to be turning from bullish to bearish or bearish to bullish? Once we've identified that we might have a market that is in the process of turning, there's always a chart pattern that precedes that turn in the market. Double top, inverted head and shoulders, descending wedge, etc. So even though we might have this, articulated or identified the phase or the condition of the market or a chart pattern, we don't just arbitrarily wade in. We wait for the appearance of what we call our insurance day bar. And remember, I have 2 definitions of the insurance day bar. One is the key reversal, where we have a washout, the market goes lower, closes on the other side at the high part of the day. Or you have what's called an inside day bar or a narrow range day bar, where the low and high of that particular bar is much lower than the previous sessions preceding that. So now, even though we've seen all phases of this particular methodology, we've articulated the condition, we found a chart pattern, we've waited for our insurance day bar. Again, we just don't wait in arbitrarily. We layer it with an execution plan in the form of a pending order buy stop or sell stop. A buy stop in a market we're looking to go long, 1 or 2 pips above the previous session high, or a sell stop where we'd place 1 or 2 pips below the session low. So let me make this all, right now it's a little bit mystifying to you. Let me show you exactly how I applied this on some recent trades, and then I'm going to open it up to your questions. So remember again, the first thing I'm trying to identify is what is the phase or the condition of this market. And this is a little bit deceptive because up to this point, the market was heading higher, and we want to be in lockstep with the trend of that market and looking to, take positions that, put us on the long side in that this market is going up. But again, when I saw this market starting to peter out, where all these days it couldn't make any advance to the upside, it looked to me that this market was going from a bullish market to potentially a bearish market. But again, just because I have that supposition, I wait for the second confirmation in the form of a chart pattern. And here we have our double top or our M top. Now the peaks don't have to be in exactly the same place, but when we stand back and take a long view, we can see that this has established a double top price pattern. Now, again, just because I've isolated the fact that we might have a market that's turning or a bearish chart pattern in the form of a double top, I wait for what we call our insurance day bar. And again, I don't know if this is too clear on your screen, but right here, this daily bar is the high and low of this daily bar is within the high and low of the previous day, hence making it an inside day bar or even a narrow range day bar. So then the fourth part of our methodology would be to place a sell stop just under the low of that bar. And here is actually an email that goes out to my elite pattern traders, which again is timestamped. So again, this is nothing that's been rejiggered for the purpose of this presentation. I put myself on the line every day. I do my analysis before the market moves, where to place these entry orders, where I analyze the chart. I put in the exact trade, which you can copy on your broker platform, and then I, have a little analysis under there where I said Euro Pound appears to have formed a double top bear price pattern. Any penetration below the low of today's inside day bar will likely result in further price erosion. So these were the trade parameters when I put in this entry order. So my risk was 42 pips, and my initial reward outcome was 159 pips, or about 4 to 1 risk reward on this particular trade setup. As you'll see, I kept on expanding my take profit as this went deeper into profitability and ended up taking 258 pips, or about 7 times risk reward. So here again was the chart at the time I sent out the email. And as you can see, we have our inside day bar with this little bar, and this green arrow indicates that we're putting our sell stop under the low of that insurance day bar. So let's see what happened in that trade. And so you can see that from the start of the close of this session to the opening of the next session, the market just went straight up. So remember again, my resting order was just under that inside day bar. And for most of the early session, the market kept on going against the direction of where I thought it might go. But again, no harm, no foul. We weren't in the market. We weren't panicking. I wasn't sitting in front of the screen, tearing my hair out. I simply went to bed at midnight. My entry order was triggered, and now I was in an automatically profitable situation because the market put me in at the time and price that it was ready to go. And eventually I got out of the market at 86.18, right down there with the green arrow, and got out with a 258 pip profit, analyzing that we had a double top bear pattern and also noticing the presence of that inside day bar, or what we call my insurance day bar, and then putting an entry order just below that inside day bar. This is another example where, again, the first thing we ask ourselves, what is the phase or the condition of this market? And again, this is a little bit misleading. This looks like a down market, but as you can see with all these prices, was unable to make any further progress on the downside. So I surmised that we were, again, in a market that may be turning from bearish to bullish. And then I said to myself, is there a chart pattern to support this thesis? And there you see a small double bottom. And again, these double bottoms can be bigger or larger, but my experience will tell me that, this was the first part of a bottoming in this market. And then I wait for my insurance day bar. And there was none until the presence of this big guy right here, where you can see this enormous washout, where the market went much lower and then recovered and closed at the high end of this huge bar. And remember, again, the larger the bar, the more indicative that trading signal is going to be. And you can see this huge key reversal. It was probably about a 500 pip day, where it closed at the high part of that washout bar or key reversal bar. So now everything lined up. This was my email that was sent out to thousands of people on my email list with the trade, with the analysis, where to place your buy stop and stop loss and take profit. And this was the initial parameters of the trade. At that time, it was pound yen, and we had a risk of 98 pips and a potential reward outcome of 352 pips at that time. But you'll see that I changed my take profit 4 times and eventually took over 600 pips out on this particular trade. And that represented over 6-to-1 risk reward ratio on this trade. So here was the setup on the chart, and the green arrow represents where my entry was going to be placed. And this is what it looked like on the chart. And you can see once the entry was triggered, the market just kept going higher. So I kept on increasing the take profit to reflect the market momentum underway. So I'm happy to stay in a trade for 3 days or 3 weeks, as long as it will have me. So the market just kept going, and I kept on increasing my take profits, this time from to 543 pips. You'll also notice that on that particular day, and this is the open position management for other trades that I had on, that I had open position profits of 753 pips for this collection of trades in that time frame. So again, most traders are targeting 10 or 20 pips on an individual trade, and in this particular instance, I had over 753 pips open on this collection of trades. So again, 4 days later, I sent out another email changing the take profit once again, and this time it increased the take profit haul to 652 pips, where it was eventually triggered. This is another example of a market where we ask ourselves, what is the phase or the condition of this market? And as it's pretty clean and clear to see, this is a downward trending market. Again, we always want to get in lockstep with the major direction of the market. And you can see there aren't any signals. This chart pattern is not really applicable. And here is our insurance day bar. You can see this tiny, tiny little bar. And again, I don't know how clear it is on your screen, but from high to low, this is just a fraction of what the ranges were in all the preceding days. So you have this coiling effect within the context of a downtrend. So I simply sent out an email where to place your sell stop to get in this market if it falls through that inside day bar. And this was the initial risk reward, 46 pips risk, 134 pip reward. We eventually increased it to 158 pips and took about 4-to-1 risk reward on this particular trade. So you can see that it was just an effortless trade where our entry order was immediately triggered. We didn't take a tick of heat. The market continued to fall, and we took a quick 154 pip winner over the course of 24 hours when that entry was triggered. So again, my whole philosophy on trading is that it should be effortless, that the market should do all the work, that we place our entry orders and our take profits and let the market put us in and let the market take us out. So of course, as I indicated, I don't win nearly as many trades as I lose. In fact, I lose over 50% of my trades most months last year, and yet I still come out with a big profit. So these are examples of some losing trades. In this dollar Swiss trade, I lost 54 pips. This odd yen trade, I lost 55. And this New Zealand yen, I lost 42 pips. As you can see, with the winners, in this case, the euro pound, I won 258 pips. Pound yen, I won over 600 pips. Dollar yen, 154 pips. And then I lost 54, 55, and 42 pips respectively. You can see in this example that the average loser is 50 pips compared to the average winner of 354 pips. And this means that one winner can make up for 7 losers. So in this case, you can see that I don't have to win on every trade. I just have to have a couple of big winning trades every month to make a big fat profit. So I can literally have 10 losers in a row and I wouldn't care. It simply doesn't matter. So in my professional opinion, being able to lose more than you win, yet still come out with consistent profits is the holy grail to trading. You don't have to worry about being wrong or making a mistake. You don't have to worry about even a string of losing trades. You know that this is simply part of the business we are in, and understanding this is what will give you true lifelong financial freedom. So before I dive into the live markets, why don't I stop here and take a couple of questions that I'm sure are on your mind. So the first thing is, I just appreciate your feedback. Do you like looking at clean charts? Do you think that this makes sense? Or does it just seem like a lot of nonsense to you?
Okay, guys. So during the presentation, there were a lot of questions. Merle says, is this a day chart? Louis says, how is the reward calculated? Let's see. Louis says, how do you determine the initial reward price? Where do you place the pending order? And so I think I'm going to take all of those questions and try and answer it, in a certain way. Now, so says there's so much clarity in your presentation, it's mind-blowing. So thank you very much for that comment. And then Phil says, did you place a single trade or a number of trades? So there are a number of questions, and I think I'm going to attempt to answer them by reviewing one trade, which really encapsulates my whole philosophy, how the market is a discounting mechanism, how the market is actually ahead of the news, why I don't trade the news, and how to capitalize on these monster moves in the market. So really what I'm referring to is a trade that I did all the way back in late April. Here was the trade in the US dollar versus the Japanese yen. So this is the dollar yen. This is a weekly trade. And the trade went out to thousands of our members around the world on April 21st. And again, there's so much that's incorporated in this trade. And I think it helps me, answer a lot of these questions by reviewing the price action, how I, approach this, and what actually happened. So based on long-term patterns, and I'm going to go to live charts in a moment and draw them out for you. But all the way back 3-4 years ago, right here, there was a double top, and then there was actually a head and shoulders. So the price patterns 4 years ago were already telling me how to look at this chart, how to view it in current time frame. And so when it kind of circled back up here, made a double top, had this little narrow range bar, I was kind of salivating. I kind of knew that the next move was going to be lower. I said all the way from late March, early April, that from a price point of 112 there, that we were going to go and retest the lows in December. And that's exactly what happened. I ended up making over 650 pips on this one trade. And Phil asked, do I make many trades? So I made many trades along the way. So the initial entry was a recommendation to sell it at 111.61. I had a stop loss about 80 pips higher. Now, a lot of people are horrified when they see a stop loss 60, 80 pips away, and they say, well, I could never take a stop loss that big. And we're going to talk about that in tomorrow's section under risk management, how to correctly size your trades. But you can take a stop loss of 80 pips or 180 pips. It just depends how big your position size is. And we're going to talk about that tomorrow. And then my initial take profit was around 108.5, which was about 350 pips lower. But, what I do is I kind of put these, stop losses and take profits at an arbitrary level. And then I see what's happening. And the market started to confirm the way I was looking at it. So I kept on expanding my take profit. I eventually got out around 105, which was right around where these levels were. And so this was the trade where I got in the trade on April 21st at a price of 111.61 as I instructed our members, and I hit the take profit at 105.17, about 650 pips lower, and I ended up making about $300,000 on that trade. Now, some of you are going to say, well, when you hold the trade, you have to pay all these fees called swap fees. These are fees that are charged by your broker. But including the $46,000 that I paid in swap fees, I still made $312,000 on this trade by just sitting in one trade for 3.5 months. I got in April 21st. I got out August 12th. So almost 4 months holding one trade. Now, this is in comparison to where most people are trading 5 times a day. If you're trading 5 times a day, you're doing 125 trades a month. And then you're paying your broker 2 or 3 pips on each trade. So if I was trading one normal lot times 125 trades a month times $30 spread, I'd be paying $3,750 in commissions to my broker. Now, this is the spread. It's kind of hidden. You don't really understand this as a component of trading. But, believe me, when you make 10 pips and 3 pips go to your broker, you only make 7 when you win and you lose 10 when you lose. This is how you get behind very quickly. But I sat in one trade and made 650 pips and paid $46,000. But if I trade in and out 5 times a day on 51 lots, I would have paid over $180,000 in spread fees. So I paid $46,000. I didn't pay, but I sat in one trade and made $300,000. So this is how I capitalize on monster moves in the market. Now, let me kind of go to an expanded discussion. So when I took that trade, the question is, where do you put your stop loss? Where do you put your entry? How do you figure out take profit? So it's not a simple, answer. It's not a one size fits all. It depends on where you get in the trade, what you view as the potential for the trade. So this was the weekly dollar yen. I'm sorry, I'm trying to just clean up this chart so we can see a little bit better here. Get rid of some of this distraction. So as I said, I look at these charts in a long-term context. First off, this is a weekly chart where each one of these price bars is 1 week in time. So I'm not looking at a 5-minute chart. I'm not looking at a 1-hour chart because you cannot see these patterns on a 1-hour chart. These patterns occurred all the way in 2015, where the market made an all-time new high, backed off that high, and made a double top. And maybe it'd help you to see it if I draw it out like this, where the market went from all the way from much lower from the 70 price level. You can't even see it. Made an all-time new high, 126, backed off, retested it. And when it comes through the neckline, it forms this double top. Now that indicates it's a reversal pattern, that the market leading up to it was an uptrend, and now coming out of it is going to be a downtrend. So that pattern all the way back 4 years ago informed me of a tremendous amount. Now, including the double top, you also had this head and shoulders, which looks just like a man or woman's left shoulder. That would be the peak, would be the head, and that's the right shoulder. So this whole thing, this double top head and shoulders sitting on top of this market tells me that this thing is going to go down. So every time it rallies, I know not to get faked out. I know not to get emotional. I know how to handle it. So right here, when this thing was rallying, I was telling our members, don't get faked out, don't get sucked into this. And then when it formed this double top right at the apex of this triangle, so in more recent time frames, it's been traversing in kind of this descending wedge triangle. So this was my trade in late April, right here, where I saw this narrow range bar. I don't know if you can see it on your screen, but this, and remember, this is a weekly high and low. So in that week, it only had like a 50 pip range for the entire week. And to me, that was like a compression. That inside bar, to my mind, was indicating that this rally had stalled out right at this double top juncture, right at this resistance downtrending line. And I just knew in my water that this was going to be a major turn in the market. So my entry was just a hair under the low of this support of this narrow range bar. So my entry was at 111.61. My stop was a little bit above the high. That was my risk. And I was saying for 4 months that this was my objective. So every time you get in a trade, your objective is going to be, different based on what you're looking at. But to me, it was very clear that this thing is tracking within this descending thing. And, I can well anticipate that you may see something like this, but eventually you're going to go down. So even if this rallies, at some point, I'll know what to do. And I ended up taking out 650 pips. I got in at the top and got out at the bottom. I don't usually do that. I'm just looking at usually taking out a piece of the middle. In this case, I knew exactly where this thing was headed. I said on every one of these boot camps, every one of my weekly video reports, that all the way here, that we had to come back and fulfill the function of challenging these lows. So I do trail it with stop losses, but I don't trail it so that I choke off the trade. So Phil says, how do you know when to get out? I let the market put me in and I let the market take me out. In this case, this key reversal tells you that there's support here. But I actually had a take profit just sitting here, just a hair above these lows. So I knew once it came into the zone that you would see some kind of support, whether that'll translate into something like this or, where it just peters out. I don't know. But I knew, by virtue of where the major support was, where I was looking to, get out of this particular trade. So Louise says, if the objective is less than 3-1, do you skip the trade? So, in August and September, these are usually pretty non-trending market environments. And, at that point, sometimes I'll take a trade where, if I can get 2-1, I'll take it down. But normally I'll set up a trade. And what Louis is saying is, so a lot of you are trading in the market. If you're trading short term, you're trying to make 5 pips. You're trying to make 15 pips. Maybe you're trying to make 30 pips on a trade. But, if you're trying to make 15 pips, you've got to risk 10 to 15 pips. That means your risk to reward is 1-1. That means you better be 80, 90% correct most of the time. Because, again, remember that you're also paying a 3 pip spread. So if you're risking 15 pips, you better make 18 pips. Because that's going to include the risk. Because every time you lose, you're going to lose 15. Every time you win, you're going to make 15 minus the spread. That's where the broker gets you. It's like kind of playing the roulette table with the 00 and the greens. That's how the house wins. So even if you had 15 pips, you have a 1-to-1 correlation. That means you better win 80% of the time, 90% of the time. Now, I set up trades where I have a 3-to-1 risk reward. That means I'm looking to make 150 pips for a risk of 50 pips. And if you have a 3-to-1 risk reward, you can actually lose mathematically 72% of your trades and still be a winner. I showed you on that one extract where I lost 60% of my trades. and yet I still made 1,700 pips. It's because some of my trades won 4-1, 5-1, 6-1. In this case, I made 6-1. That means I can have 5 out of 6 losing trades and still be a winner by just having this one trade win. And this is the opposite of what most people are doing, where you're getting in and out after 10, 15 pips. You're trying to scoop out 5, 10 trades a day. And mathematically, that's just against you. You cannot win on a sustainable level over time doing that. You need to have a big winner. So I only look for 1 or 2, sometimes I get 3 big wins a month. And that helps me overcome all of the little, losses, the break evens, and the losers that inevitably will come along the way. So LK says the dollar yen head and shoulders pattern was 4 years ago, and price did go down after a break of the neckline. My question is whether the pattern is still valid 4.5+ years later. Will it be relevant forever? And that is an excellent, excellent question. Let me just get out of this. And the answer is no, it won't be relevant forever. But I was looking at the head and shoulders and this descending wedge. And now, if we start coming through here, if we start kind of busting out, so sometimes these descending patterns, they can be continuation patterns or they can be reversal patterns. So this actually would be kind of a reversal. This would be a continuation of the current downtrend. And so the market will ultimately be the referee. But, I could see that once it made these bear price patterns that directed the market lower, there was no opposing pattern that then said, okay, now this is a double bottom, and now I'm going to start going the other way off that double bottom, right? So basically you have this descending pattern that is just creating a scenario of lower highs. So every time the high is lower than the last, and maybe we come up to the 108.5 here. But, to my mind, we're coming down in a sawtooth pattern lower. So right now, I'm looking at a combination of those long-term price patterns, which kind of told me how to and this, descending triangle. So that is an excellent question, LK. And I will then monitor things if something changes. So if I see an opposing, pattern now, where maybe this is now a triple bottom, but in order to be a triple bottom, it has to kind of go through the neckline and confirm this. So it has a long way to go to change the behavior. But if we start coming out here, then I will start, obviously taking that into account. So the market is dynamic, the market is fluid, and ultimately I look to the market for direction. And, it's a long answer to that question, but basically, I think, that's how I would answer it right now. So Dave says, I cannot make day 2 of the recording. Can I get a recording? So if you want a recording, just message our support team. I'll put the link here, support@thepatterntrader.com. So if you want a recording, or if you have any other admin related questions, go ahead and direct it there. So are there any other questions about my price pattern trading methodology? I'll show you one other pattern that I'm looking at that'll give you an idea, how I look at things globally. And then tomorrow we'll actually set up, you're welcome, Dave, a trade under live market conditions. So this is a trade that I've been looking at for years. 2 years ago, I was telling our members to start getting long the pound versus New Zealand dollar upon the observation of a long-term reversal price pattern. So you can see that prices obviously crashed lower. And then you can see right here that we had a double bottom right there. And then within the double bottom, you can see that I also look at the price action. What I mean by a price action, you can see that this made an all-time new low for this pair, but by the end of the week, it closed 1,000 pips to the other side. And by closing at the high part of the bar, it actually pointed in the direction it was going to go. So this is why some people say, why don't you trade candlesticks? I like to see where something closes relative to the high and low. So again, this particular week, it made an all-time new low, but by the end of the week, the buyers were firmly in control. It closed on the opposite side of that, stick or whatever you want to call it, the weekly bar. Then it circled back around and made this second bottom. And you can see the price action, same thing, made a new high, made a new low, closed on the high, made a new low, closed on the high. And then you can see right here, made a new low, closed on the high. And right there, I started saying, get long this thing. And we made about 3,000 pips on this move on a couple of positions. So you can see that this was the double bottom that I believe is directing traffic in this pair. So you can see the double bottom. There was also a rounding bottom, and both the double bottom and the rounding bottom were connected by this neckline. A neckline is simply a line drawn through the pattern. And whereas this was old resistance, this has become new support. And you can see in the more recent time frame that we double bottomed right at this support line. And if we cross this area, watch out. I don't think that that is going to be far-fetched. This is what I've been saying for years and years. I can show you all my emails going back a long time ago. I'll show you some of my recent emails where basically, based on the double bottom here, the coil, I suggested getting it at 189.57. Then I suggested doubling up. I said I'm currently long pound New Zealand and I'm adding to my position at 189.68. And right now we're trading 300 pips higher. Then I said in this email, and this is all recent, this was 27th of August, I said buy the dips and or the breakouts, effectively buy anywhere. So I bought all over the place. Right now I own the pound New Zealand at all kinds of places. And here was another one, buying it at 186.72. So this is where I saw the initial double bottom. Then I looked for my insurance day bar. Here's the key reversal at 186.72. And I took out 300 pips right out of that trade almost immediately. So here we are, 192.16. I'll show it to you on the daily, what I've been looking at on the daily charts and the weekly charts. So sometimes you see the daily and the weekly charts kind of line up. So here is the double bottom. The bottoms don't have to be in the same place. So you can see this bottom is kind of lower than the other one. But when you look back, this looks like a W. So it doesn't matter if one is longer than the other, if they're symmetrical. The fact is that you have this W, this double bottom. And with the word bottom in it, it means it's going to do what? It's going to go higher. Now, in addition to the double bottom, you also have an inverted head and shoulders. And here's the neckline. Once it broke out here, it broke out, retested it. Now you have this key reversal. And like I said, I was going to set up a trade on a real-time basis tomorrow, but frankly, I would go ahead and buy a new high in the next session. If this thing, I would just put a buy stop somewhere if it closes. So you can see this is now a key reversal in the direction that I'm looking at. So by virtue of this double bottom, this inverted head and shoulders, now these reversal patterns tell me which direction I should be faced. Then I just wait for prices to sort themselves out. I wait for my key reversal where the market makes a new low and closes on the high. Now, this is why I wait to the end of the day, because right now it's closing on, or it's trading at the high end of the range. But let's say by 5 o'clock when this thing closes, it's going to close down here. That would change the entire character of this. It wouldn't be a reversal, and I would simply just sit it out or wait to make another decision. So that's how I look at the markets. I look to take pieces of the market out based on reversals or trends, and then I use a combination of methodologies to get in at the right time and price. So LK says, do you trade on the daily or the weekly chart? So I just showed you in the example of the pound New Zealand where I toggle between different time frames. I showed you, what I was looking at on the weekly, and then I'm seeing something corroborate itself on the daily. Now, sometimes I will take if the weekly is obviously a long term thing, and you get opposing, you get counter trend moves, and I will take those, but that's a discussion for another time. So I look at all the long term time frames, but remember that my objective is to take out the big moves in the market. So I want to take a piece of the middle out of a move that goes substantially higher. And you can only do that by looking at long-term charts. You cannot see a move that is shaping up on a 15-minute chart or even an hour chart. So it's not because I just think that looking at a short time frame, it's really gambling. The market can go anywhere in the next 15 minutes. If I see a double bottom on a 15-minute chart, yeah, you could bounce 40 pips and get a nice move out of that. And then 3 seconds later, it's back in your face because you don't know what you're holding. You don't know what that double bottom was. It was a temporary thing, and it held the market for 15 minutes. So I toggle between the daily, the monthly, and the weekly to determine how to get in and take advantage of monster moves where I can sit in a trade like the dollar yen for 3.5 months and be completely comfortable. And believe me, in those 3.5 months, it went against me many times. And that's the other thing. It's easy to kind of just point this out now, but when you're in a trade and you're sitting in there for weeks and months, it's going to go back and forth and all. And if you don't understand why you're in that trade, you'll never be able to hold it. So just because I'm making these monster moves, it doesn't automatically mean that you will. So if there are not any more questions, I'm going to cut it off there. So Lynn and Patty are asking about the Australian dollar and the RBA rate cuts. So I don't really care about what the Fed does, what the Bank of Japan does, what the Central Bank of Australia does. I look at everything in terms of price. Price is ahead of events. So by the time the RBA cuts or doesn't cut, price has already reflected what that market is going to do within the cadence of the pattern. And so, every Friday I do something called Master Pattern Trader. I'm not going to jump ahead, where I analyze all of the major charts, what the setups are, where they're going to go. But, what I'm trying to do on these boot camps is educate you on how I apply this methodology. So I'm not going to use this occasion to look at a whole bunch of charts. I do that every Friday. If you're interested, you should jump on the Master Pattern Trader sessions. And I'll talk a little bit more tomorrow how you can do that. So LK says, to me, the most challenging part in the strategy is to determine the phase and to identify the historical pattern. Will it work if we replace these two steps with a moving average or price? So again, I don't claim to have all of the answers. If you take a piece of what you like of my methodology and you want to overlay it with something else and you feel like it gives you an edge, then you should do that. I know how I look at the market from how my mind works. And when I was looking at dollar yen and I took out over $500,000 because I traded dollar yen, on multiple positions, I just looked at it on the same price chart that I'm telling you right now. When I saw it at 112, I knew exactly what I was looking at. I didn't need some moving average. I didn't need anything else to tell me what I was looking at. So Rufus says, thanks for a very informative session. You're welcome. Peter says, what do you think about defining swing chart? Well, this is really what I'm doing. This is a swing. It's a swing from lower to higher. So swing trades usually last from 1 to 3 days. And basically that's what I do. So my average holding is 1 to 3 days. But, as you saw with the Japanese yen, when I see something good, like I do here, I think you can sit in this trade for weeks, as I intend to. So, I don't just talk out of both sides of my, what. Here are my trades in the pound. So I put my money where my mouth is. So you can see that I've got, and I just sit in them. Wait a minute. And I'm, right now I'm taking some losses, but so here are my pound New Zealand. I bought some at 193.39. I bought some at 192.25. I bought some at 191.30. And right now I'm losing about 20 grand. So we'll see how that works out. But, you can see, and I don't have any stop loss or take profits, and I don't want to get you guys in a bad habit. But, when this thing cratered from, 193 last week where I got in all the way down here, I didn't freak out. I think I know what I'm looking at. So I'm looking at this from the long term. And I guarantee by the time I check back with you, those positions could be worth $500,000. So I'm just going to hang out with them and see what happens. All right, guys, I think I'm going to love and leave you here. I'll see you back tomorrow, 11 a.m. Eastern Standard Time. So hopefully all of you will be back there. So we've got some people also on YouTube. We really want to thank you. Gentleman says, thanks for sharing your remarkable knowledge and information. Gary says, I like clean charts. Jeff says, what pairs do you trade? So I trade all of the active pairs. Here's a list of all my pairs. I trade about 25 different currency pairs. I trade, some of the global stock indexes. I trade oil, gold, and silver. So most of the major currencies, all of the liquid, obviously the dollar correlated pairs, the yen correlated pairs, and just the mainstream. Nothing, that's highly illiquid. I'm not going to trade the South African rand or the Russian ruble. All right, guys. Thanks a ton. I'll see you tomorrow, 11 a.m. Eastern Standard Time.